Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. It's 101 on the East Coast. We're late because I was impaling myself with technology. They blinded me with science, but this is Market Call. How are you, Dan?
I'm doing okay, Guy Adami. You're all fired up here today.
You know what? I am fired up. I'm always fired up. I got to watch some football last night. It's funny, and I know we're not here to talk about that. That's not what we're tasked to do. But there's certain teams when you watch them play, the Eagles, for example, you just know they're going to win the game. Like that game last night was never in doubt. The question was how much they're going to win it by. I wish I had that luxury as a New York Football Giant fan, but I don't. Back to you.
Yeah. What do you think about those Cincinnati Bengals, those unis, the white with the black?
Love the throwbacks. I like when the Bengals, they had written Bengals on the side of the helmets. I don't like the stripes, but I like the whites. I like that whole whiteout thing. And as I said on Fast Money last night, Boomer Esiason, a big fan of all the things we do. He was inducted into their Ring of Honor with Chad Johnson, now Chad Ochocinco. I love that, by the way. You know something? You wouldn't think I'd like him. I love Chad Ocho. I love everything about him.
Okay, so why do you say the name? You won't say Alphabet. You won't say Meta. You won't say Block, but you say Ochocinco. And I'm just going to say this because I know your buddies.
I won't say Coach Prime either.
I know, but I know you're buddies with Boomer. You are Guy from Morristown who calls in to the Boomer and Carton show. But, I actually think that's a little disrespectful. Boomer should go in on his own. He should have his own Ring of Honor day. I'm just going to say that because I think he put that team on the map. But, Guy, that's not what we're tasked here to do.
No.
All right, let's talk about
By the way, and before we get into and it is an important market day.
Yeah.
There are two quarterbacks in the NFL that besides Daniel Jones. I love Jalen Hurts. I love everything about him, and I love Joe Burrow. And oddly enough, those are guys sort of matched up against each other. So I love the two of them. There's just something about them. They get it. Anyway, let's talk about the market.
Real quickly, what do you think of the chances? Are we going to have a rematch, Eagles Chiefs? Is that what's going to be the?
No, I'm going to go out on a crazy limb, and I'm going to say I think the Eagles. But he loves the Cowboys. But, the Cowboys proved once again this past Sunday, you just can't trust them, and you can't trust Dak in a big spot, number one. I love the Niners, although I don't know. Brock Purdy, I don't see it yet. I think the Eagles are the NFC, but I'm telling you something. The Dolphins, their offense is off the friggin' charts. But the Chargers, I think that win against the Vikings this past weekend, I think that set them up to sort of get things in motion. I don't trust their defense. I know their wide receiver, Williams, is now out for the year with an ACL, but I like what's going on in San Diego. Anyway, there you go. Back to you.
All right, back to me. All right, let's talk about the market.
Because it's a market day.
It's just, man, we were talking about it early last week when we started on Market Call, on the tape, on everything that we do in Fast Money, okay? We're like, will the market, which is not pricing anything for that Fed meeting, okay, will it react to, a hawkish pause? And we got the hawkish pause. That was what was expected. And when you think about what rates did, you think of the knock-on effect in the stock market. What were the things that got hit? Banks did not trade well. High valuation tech did not trade well. Small caps did not trade well. And it's continued on. And I just look at a day like today and listen, it's only 105 or something like that. But, earlier I looked, Apple and Microsoft were both down 2%. You had Google and Amazon down nearly 3%. Here's that S&P chart. This is the futures here. And this is really a penny. Yeah, well, it's interesting, Guy. When you look at that, look where that 200-day moving average is. Look where we have that uptrend that's been in place. You violate some serious technical levels, and we've been showing for a reason those Microsoft and those Apple charts, and the fact that they broke their uptrends that had been in place, where those two companies gained more than $1.5 trillion off of those lows early this year or late last year, and they broke the uptrend. That's why technicals are important. That's why we love having Carter Braxton Worth on the show, because he can speak to it through a different lens. When you and I are throwing around valuation levels and catalysts and relative strength, this and that, whatever, sometimes it's easy enough just to look at the charts and they tell you what's going on under the surface.
Mixed metaphors notwithstanding, yes, I agree with that, and we love having Carter on. And listen, technicals matter. People say to you, why do they work? It's because at a certain point, a lot of these things become self-fulfilling. You discussed it yesterday, but people or machines or whatever, they put in certain buy or sell orders or stop loss orders based on levels. So these things, again, self-fulfilling, and they trigger themselves. But the other thing that seems to be triggering himself is Jamie Dimon. And you say what you want about this cat. I like him, well, for a myriad of different reasons, not least of which Karen Feinerman loves him. But he seems to tell it like it is, as opposed to like a Brian Moynihan, who I think is completely full of shit. You can edit that out for YouTube. But, Brian Moynihan, everything is fine. Everything is great. At least Jamie Dimon has been pointing out now almost for the last 2 years some of the things that he's been concerned about. And a lot of these things, Dan, are coming to fruition. And yesterday he talked about something in India, talking about he's trying to prepare the market for higher rates. And as we sit here today with the 10-year yield again, significantly north of 4.5%, levels that a lot of people didn't think we'd get to, that's posing to be problematic for the market. And we've said it. There's this point of diminishing marginal returns. Yields will sort of get to that point where the market no longer basically ignores it and starts to pay attention. And we've clearly gotten to that point.
Guy, I find it interesting, and I get what you say about Jamie. I don't know him. He's been a market voice, an impactful sort of participant. As long as I've been in the business since the late '90s, and I wonder why a comment like that comes out in the Times of India. You know what I'm saying? Like, it's so impactful. It's such a big, we've been quoting what he said from 4 months ago when he said, be prepared for 5, 6, maybe 7% Fed funds, right? So I find that kind of weird. I think it's like his kink. Like, I think he really enjoys like throwing some shit up against the wall and see what happens. And, again, I'm not going to, Moynihan comes from the Bank of America. And if you ever read any of the books, I think it was Clash of the Titans, which was a great book that came out.
Great movie too, by the way.
Well, no, it came out. You remember when like Too Big to Fail, Sorkin's book and all these other books about the financial crisis and everything came out. This one was actually really good. I can't remember who the author was, but it talked about how Bank of America, like how it was built over the last 40 years or so. It's just a different culture. Okay. Like to be very clear, Jamie's right here, right in New York, and he's been in the mix of all of it. You know what I mean? And so, and so it is what it is. But I think they have different franchises. So
no, that's fair. Look, it's absolutely fair. I guess my point is, and why because I am not this person. Like, I understand people always want to be optimistic, and I've said this, and I want to be completely honest. I was raised in a Wall Street. What can go wrong will go wrong. So I'm predisposed to be negative about things. And that's just me being honest. I get it. I think Brian Moynihan, to his credit, I guess, is sort of wired differently. He's the eternal optimist. And I wish I was more like that at times, but I'm not. So I admire people that basically can see through the bullshit and say it like it is, or at least the way they see it, as opposed to everything's great, when it's pretty clear that everything isn't particularly great.
Yeah, but that being said, dude, like we've tracked a lot of Jamie's comments. We do it here on Market Call every day for the last couple of years. He's been all over the place, dude. Like, remember the economic storm is coming and this and that. And you know who was right about that? When Moynihan clapped back and he says, well, we're down here in North Carolina in the eye of the storm, usually in most storms that make landfall, and I don't see it. And he was right about that. Okay. So like, I mean, listen, you and I are just kind of debating it, and maybe it's just semantics a little bit, but Guy, you and I have been talking about this. And I always think that, when you say that you grew up in a Wall Street, what could go wrong, or what can go wrong, could go, whatever the hell it is, whatever.
What can go wrong will go wrong. Yeah, prepare for the worst, hope for the best.
Yeah. And I think that one thing that I've known about you, and I've sat next to you now on Fast Money since 2011. You and I have been doing content every day for the last 3 years or so. You also have a soft spot in your heart for some of the data as it relates to consumers. Like, we talk about
stocks.
Yeah. No, I know, but we talk about stocks, we talk about markets, we talk about billionaires all the time and this and that, whatever. But at the core of this, 70% of our GDP is a consumer. And, a disproportionate amount of that, kind of incremental, consumer, I guess, consumption when things are really good is being bought by people who shouldn't be buying things on credit they can't afford. You know what I mean? Like that sort of thing. And you've always had, I think an eye out for that. And you're sympathetic to that. It seems like we're in a place, and I saw a stat this morning, I think it was like a Fed survey, where it's just going to be very soon the top 20%, okay, of like the wealthy people in America are going to have excess savings post-COVID, and the 80% have just worn it all down. And then, $1 trillion of credit, you know what I mean? Like consumer credit on credit cards right now. It seems really unsustainable. Any sort of slowdown in this economy, especially where gas prices are, with other inflationary pressures picking up, when wage growth is decelerated, seems like a really bad setup right here, Guy.
Yes. And this is not Guy railing on the Federal Reserve, but again, in a low interest rate, money is free environment, it does not help the lower and middle class. It helps the wealthy. I mean, that's just fact. I mean, people can debate it all they want. The facts are what they are. People that own shit are the ones that do well, and people have the ability to buy stuff are the ones that do well. And then when they're trying to combat the thing that they created in the first place, who gets hurt in higher inflation? Not the wealthy people. I mean, it's actually laughable for them. And quite frankly, at a certain level, they actually do better in a high inflation environment. It's the lower and middle class. These people get squeezed on the way in and on the way out. And that's something I've been trying to point out for a while. And it's upsetting to me that this wealth gap that we've talked about for years, Dan, continues to widen. And you wonder why people are pissed off. That's why they're pissed off, because they feel as if they're not keeping up. And you brought it up yesterday, I believe, on Fast Money. You brought it up on the Tape, Market Call. Politically, I think it's very difficult for this administration. They can tout the economy all they want. The reality is people vote with their pocketbooks, and I don't think people feel particularly good about things right now. So if the stock market were to give it up, and I'm not again, I think it will. I'm not suggesting I'm right. That's going to be problematic.
Yeah, I guess the point, I think that this is something we're going to spend a lot more time on. If you think of, and I think what I said last night on Fast Money is, if you think of the, voting members of the Fed and higher for longer, they think the economy is actually too hot right now, right? So higher for longer in interest rates speaks to the fact that they still want things to cool a bit. But if you look at some of the polling about the Biden administration and how they're doing with the economy, and granted, this is, more than a year out from the election and that sort of thing, but his disapproval rating, you know what I mean, is just, I think it's the highest disapproval rating that any incumbent president has had a year before the reelection. And then when you look at just specifically on the economy, so if voters, like to your point, are saying no bueno, you know what I mean? And that's something from my main man, Doug Cass. He wrote something in to us this morning. We're going to hit a couple of those things that he was talking about in his note on Real Money. But I think that those two voting blocks, Guy, are I'm probably going to go with the consumer, the person voting in that poll, rather than what the
Agreed.
Fed. Know that the Fed's not particularly great at targeting.
So it's interesting, and this genius Neil, if Neil's watching right now, hello. But this genius Neil Kashkari, who's been, it's almost impossible to be as wrong as he's been, and to be as arrogant about it at the same time. I mean, it's quite remarkable. But you spent time in London, right? Didn't you, or no?
Yeah.
I used to stay I used to go for like 2-week blocks. I used to stay at the Savoy. Yeah. And why you mentioned this guy? It's like, okay, I'm going to tell you why. Because what you learn in London is, when you cross the street here in the United States, you look one way, because that's the way traffic goes the other way in London. I mention that because these Fed officials are looking the wrong way. They're looking right when they should be looking left. They're looking clearly in the rearview mirror. If they were just to pay attention to some of the things that are bubbling up around the surface, they would realize that you could say all you want about the economy being great. There are cracks in the armor. And I've mentioned this before, and I guarantee you people will start talking about this. The unemployment rate in California is now north of 4.5%. It moved about a percentage point higher over the course of a few weeks. California typically leads the rest of the country, I don't know, month and a half, 2 months or so. So get ready. That unemployment rate that everybody's sort of hanging their hat on, it's gonna move very quickly in a very short period of time. And I don't think the market is necessarily prepared for it. And before we go to our next slide, I'll say this. The same way the Fed thought they could control inflation, which clearly they couldn't do, is the same way they think they can control the unemployment rate, which, by the way, they won't be able to do either.
All right, let's look at the S&P 500. Let's look at the E-minis here. On September 5th, Guy, if you recall, Danny
You were in
Moses.
Chicago. I know what it was. You were going to see the Pearl Jam.
We were going to see just Pearl Jam, Guy. We were going to see Pearl Jam, and we did the market call from CME Group. And, Danny actually did a trade. He was really geeked up. He was super bearish. And if you just look at that chart of the S&P 500 at the time, it was trading around 4,500. He shorted the futures there. He was using a 4,600 stop at the time. His first target was down there near 4,300. He was targeting that uptrend that's been in place from the October lows. But his next target was down there 4,100. I think all three of us were in the camp that we thought we were going to see a retest of 4,200. So Danny gave me a quick update today on this trade. 43.30. He covered half the position. And I think this is really interesting to think about. Look at how good Amanda is with these graphics.
Amazing.
AD. And he's moving down his stop on half of the position.
Yes, trailing stop. Trailing stop.
4,600, Guy, now to 4,500. And I think, I guess, if he gets to 4,200, 4,190, that's that kind of rising 200-day moving average level or so, you probably take the trade off because, again, think of the market that we have been in over the last, call it 9 to 10 months or so. This sort of sell-off has not been, something other than we have to go back to, the kind of regional banking crisis in March to see that sort of move. So again, you look at the chart, I see all those lines coming together. I see support at 4,200, Guy. I'd probably take a breather. I shorted the QQQ last week here. And if we get back to that kind of breakout level from May, I'm taking it off. So thoughts on Danny, how he's trading the S&P futures here. And do you agree with his levels? And do you agree that 4,200 or so would probably be a good level to exit the trade and take another look?
Yeah, no, the levels are right. We said it that day. The levels were right. People asked us, it's a pretty tight stop in terms of the initial stop. If you go back to the first slide where he put on the trade and where his stop was, like you weren't giving yourself a lot of room. But we said, look, the nature of the beast is that's exactly the right place to have it. It worked out. I don't think there was a day of pain in this trade. And now here we are. So taking off half makes sense without question. Trade the market. Don't let the market trade you. I say that all the time. And then lowering the stop, making this now a trailing stop and lowering it from 4,600 to 4,500 makes a lot of sense because it guarantees a profit in the trade if you just stick to that. If the trade were to go lower, if we were to break, I think that sort of, and if we could put up our chart, if we were to break that uptrend line, then things are going to get really interesting very quickly. So then we talked about potentially adding on weakness. Now that's sort of next level shit, but that's the way I've been thinking about it. But the levels are right and the discipline is right. And when I say trade the market, don't let the market trade you, the move that we've seen almost forces you to do something. And Danny did it exactly correctly, I think.
Yeah, and I would say this, that sometimes when you have a trade on, now this has been on for, 2.5 weeks or so, like this, or nearly 3 weeks. Sometimes when you get to the levels that you predetermined and you're doing things like the plan that you set out, the stop to make sure that you don't lose too much, and then the downside where you're going to take some off and move the stop down. I mean, sometimes it does make sense to close out the trade and take another look, let the market breathe for a minute, maybe a day or so, and then think about how it reacts at those levels too. So good trading by Danny. Guy, I want to go to this comment, and again, this is from the Times of India with Jamie Dimon saying that the world's not ready for 7% Fed funds.
Absolutely not.
I know, but look at this 10-year. Okay, so Carter this morning on Worth Charting had his catching up with Carter. Great little video there, and he thought that the 10-year, and he's been detailing it, on Market Call over the last few weeks, would be rejected at that prior high from a year ago. He's calling it now. He still thinks it's a bit of a head fake. We use the support level that we've seen off of those kind of May lows, and those May lows were 3.25, and here we are about 4.5. Guy, he uses it as a little bit of a channel, and he thinks it's getting a bit extended, and he thinks it's going to be a head fake. He thinks you're going to have a retracement. So what is it that, what would be the thing that would cause this to explode, I guess, to the upside?
So let's play it out in terms of both sides of this equation. I think what keeps rates moving higher, in my opinion, are, again, this persistent inflation that's going to reaccelerate. We've talked about that. into September, October, November, into the fall. We saw a glimpse of that the last reading. That's number one. Number two, supply demand thing. I mean, the market is demanding a higher yield to buy our debt. Rightly so, by the way, with the debt to GDP approaching 145 or so percent. And the third thing, and we've talked about this, and people say, why should I care about Japan? The reason why you care is because they are the largest holder of our treasuries, and they're clearly doing something in order to try to support their currency, which, by the way, they're failing at. And I think they've been selling treasuries. So it really comes down to supply and demand, which is why, personally, I thought rates will go higher, and I think they will continue to go higher. Next part of that question is, why would rates go lower? Well, this is my opinion again. I think rates would go lower on the back of a dramatic market sell-off. Now, we're clearly at an uptrend line in the S&P. We're clearly at support. But if we were to start to break down in a meaningful way, what I think is going to happen is a flight to quality in the form of bonds, which makes yields go lower, and or the this debt ceiling, which, by the way, we're a few days away from now, 4 or 5 days away. Nobody seems to be talking about it. I looked on my Google machine. I don't think they figured it out yet. I think if something were to happen on that front, as counterintuitive as this might be, the market might find its way into the bond market on this, again, perceived flight to quality. Back to you.
Yeah, that'll be a pretty interesting one, and you've been detailing that for the last week or so. So it'll be interesting to see how markets react to that. We have a VIX that's 1840 or so. I mean, like, listen, I think some of this downward volatility we've seen in the stock market has to do with this. Listen, markets, investors, we don't like uncertainty, right? And what we have right now, a whole heck of a lot of it. And you go back to 2011 and 12, and all these games were being played with the debt ceiling and the shutdowns and the ratings downgrades of U.S. debt. I mean, our markets went haywire for a bit in those periods. So, I think that when you have this much complacency, and then you and I've also talked about, and that's one of the reasons why, listen, I'll say it again, we show up every day. We're doing this stuff every day, and we're talking to you guys, like timestamp it all. We're right, we're wrong, this and that, whatever. But we're really trying to kind of navigate through some of the stuff that we spend a lot of time thinking about, reading about, talking to people about, or whatever. And I just think that what's gone on under the hood, as we've detailed here, is not particularly great. If you look at the NASDAQ 100, let's pull that up for a second here, okay? Like, without this top 6, 7 names, okay, without this AI excitement in and around them, you got a market that is probably flat to down. We've been talking about the equal weight S&P for a while. That's the RSP, the ETF that tracks it. But look at this NASDAQ E-mini, the 100 futures here. It's just broken this uptrend that looked like a monster, right? It was just like, it got a bit extended a few months ago and it came back in or whatever. But look at where that 200-day moving average is, okay? And then why have we been talking about Microsoft and Apple? They broke their uptrends before the QQQ did. Those two names made up $5 trillion in market cap. They made up like 20-some% of that index of 100 stocks. So if the two leaders that gained more than $1 trillion in market cap from their lows this year are breaking technical levels, well, then you better watch out for what comes next. And what I think comes next is NVIDIA and Tesla, two of the last sentiment leaders. They're both down about 15 or so percent from their recent highs, but they've outperformed so dramatically. So to me, when I think about tech, I'm like, watch out below, because if it goes back towards that breakout level from May, which is near that 200-day moving average, like the S&P is very close to getting to, Guy, then I think you're going to have some problems in the broad market. And don't get me started on bank stocks. Don't get me started on industrials. Don't get me started on transports. I mean, the list goes on. And then unprofitable tech. What about cheap tech? What about fintech? What about PayPal and stuff like that falling off the bottom right of the chart? There's just a lot of stuff out there that acts really bad.
You're getting exorcised. It's amazing. NVIDIA is actually unchanged on the day, which is crazy. But, as I mentioned, and, I sat on the desk Fast Money the night NVIDIA reported earnings. I think and I saw the print. So, but somebody or some machine or something bought stock, which means somebody sold stock at $516. And I was sitting there listening to some of the commentary about trillions and trillions of dollars worth of addressable market, and they dominate, and, all the bullshit that you typically hear. And that stock is now down approximately, $100-ish since then. Keep that in mind. There's also still a gap in the chart going back to the spring. Keep that in mind. So number one. Number two, Taiwan Semi, which I've said, and I believe this to be the case, I think it's one of the 5 or 10 most important companies on the planet. This stock is not traded particularly well. $82 is a huge level of support. You can see it there in terms of the previous lows we made back in May. Has not traded well now since the middle of the summer. Keep an eye on that. That double top in SMH that we have talked about. I mean, I guess the first 2 things that I've talked about lead us to the SMH, but why don't we throw an SMH chart and look at a little longer term? Because you will see a textbook double top in this thing. And Tim Seymour talks about this. I will bring it up as well. Basically, semiconductors are this generation's oil. And if this starts to roll over, and if this double top is in place the way we've thought it's been now for quite some time, there's going to be some pain ahead for the semis, which theoretically should mean there's pain ahead for the broader market.
Yeah. I mentioned this last night in Fast Money Guy. I thought, it was kind of interesting coming into September. It seemed like a lot of folks, for seasonality reasons and the like, just, thought the S&P would be down on the month. We had Tom Lee on the Tape podcast a few weeks ago. He made Danny Moses a bet that it would be up on the month. Tom's been a staunch bull. And right now the S&P is down nearly 5%. The NASDAQ is down 6.5%. That's on the month. It's interesting. Sometimes when the crowd is right, it seemed like most of the strategists, most investors, most pundits, thought we'd be down. What does that tell you a little bit? Because, a lot of folks were very skeptical about the market heading into this year. We closed, very poorly, at least in the NASDAQ. The S&P had come off its lows late last year a little bit. And so it's been, I think, you hear that expression, the pain trade, where's the pain trade? Well, the pain trade was higher this year, every step of the way. And it took a while. A whole host of strategists threw in the towel, I want to say, this summer a little bit, and it seems like that was the exact wrong time to do that. So what do you think? What's the pain trade right now for equities here? Like, especially as we think about, we're getting towards the end of Q3, so we're going to have AK, NOV, and DEES, Guy. What's the pain trade for the balance of the year?
Well, I think it's lower. I understand why people would say it's higher, because I think there's this belief that people are underinvested or whatever. I don't know that to be the case. It's money on the sideline, all the bullshit that we've heard for years, which is just it's just a really lazy thing that people say when they don't have an answer to describe something. But I think if you think about it, if the majority of the people are long stocks, pain would be most at the highest level if stocks were to continue to go lower. And, I thought last year, again, not to play Monday morning quarterback, but I thought last year we did a really good job. We were bearish for the entire year. There were 2 times last year where we thought stocks could go higher. Once it happened in June, where we thought you could see, a 15 to 18% rally. We saw that. And again, in October, we saw that. This year has got me completely off sides. And I'll be the first to say it. I didn't think, that December, January, February move late last year, early this year, clearly took me by surprise. And then the strength vis-a-vis everything that happened after Silicon Valley Bank took me by surprise. And I clearly underestimated the amount of liquidity in the system. But now things are seemingly starting to happen the way we thought they would happen. At least I thought they would happen many months ago. So, has I been wrong directionally? Absolutely. But does that mean, these things can't play out? Absolutely not. And does that mean the pain trade lower isn't in play? I think the pain trade is lower here.
Yeah. All that being said, Guy, okay. So, we were, I think, equally bearish in the last few months of 2021, and the S&P and the NASDAQ continue to make new all-time highs every day. Okay. But the stuff that we were calling out in the back half of 21 was all the right stuff. It was about sentiment bubbles bursting, and we were seeing them in SPACs. We were seeing it in meme stocks. We were seeing it in unprofitable tech. We were seeing it in all the crypto bullshit, all that sort of stuff. And it really set the stage for a trade that was non-consensus. The S&P topped out the second or third trading day of 2022, and you could just sell every rally. I think about 2023, and without this AI virus that infected about 24 stocks in the stock market, I actually think we've been right on a lot of stuff. Yeah, there was some stuff like cyclical stuff that got going, and you were right on energy. You've been pounding the table on energy all year. I was like a moth to flame. Just like, I hate bubbles. I hate like just the irrational exuberance that exists around in NVIDIA. I'm fairly certain NVIDIA is going to be much lower at some point in the next 6 to 9 months or something like that. It doesn't mean it's an indictment on the company or their products or their strategy or their management or any of that sort of stuff. It's just, this is a massive, massive bubble, and it's all going to burst at some point. I don't mean crash. There's going to be stocks that crash. I don't mean the market's going to crash. I'm just fairly certain of that. So again, you know what? We're not your hedge fund manager, your stockbroker, your investment advisor, or anything like that. We're just showing up here. We're talking you guys through it. So I hope you enjoy that. All right, guys, I want to talk about a couple other things because we got to get out of here in a few minutes. I mentioned Doug Cass. He sent us an email earlier today, and I got to tell you, somebody taught me this, a really smart guy in the markets about 2 decades ago. Watch stocks like Cintas this is CTAS, okay? They make uniforms and they do all this stuff in offices. If you don't know the stock, if you don't know the company, it's a $50 billion market cap company, guy, okay? Its stock's down nearly 5% today. They had a beat and a raise. It just wasn't good enough. It trades at 33 times this year, and it's only expected to grow like 10% on like high single digits earnings or on sales growth. So a $50 billion market cap company that's very economically sensitive, that puts up a beat and raise. The stock is very near an all-time high, right? And it can't go up. It actually gets just, what does that say to you about where we are and what investors are now starting to get their antennas up in the markets?
Yeah, I think, and Doug pointed this out, and I'm glad he did, but to me, this is a tell on sort of the employment picture and what's really happening below the surface. And if this is an indicator, I think it sort of reinforces the point I made earlier about California leading the rest of the United States in terms of employment and the unemployment rate. So I look at this and I say, you know what? We're looking at an unemployment rate that's probably going to approach 4.5% by the end of this year, which I know a lot of people will find that hard to believe, but I think that's in the cards. Other people will say, well, that will be a great thing for the stock market. I'm not so sure that's the case. I mean, we could be in an environment now where bad news is, in fact, bad news, but we'll see. But I look at this, and to me, this is just a leading indicator as to where the employment picture is going to be.
Yeah, no doubt about that. It's just interesting. Again, if the market, is a mosaic, I stare at my FactSet machine all day. I got my, like hundreds of tickers set up in different sectors, and I think about it as like a bit of a heat map. And I'm watching them, and I always think like stocks like this, and which is, we're not in the meat of earnings season, sometimes are pretty decent tells. I want to hit your gold for a second. I'm just going to call it your gold because I know that you and Danny are strong proponents of having low single-digit percentage of your portfolio exposed here for a whole host of reasons. You've made the case very succinctly over the last couple of years, and you've highlighted the fact that central banks, hedging against, I think, as you call it, their own ineptitude, have been buying the gold bullion there. Not a great chart. Let's just talk about the technical setup. Let's talk about the price action here. I mean, nothing, but guy, nothing to do yet, right? Especially, again, it depends whether you're thinking about it as a trade or you're thinking about it as a allocation within your portfolio, because here we are. We've been kind of dealing with that 200-day moving average. You see that well-defined downtrend. You see that support here. If it were to break that support, where are we going? And would you add to it? That being said, if it breaks out, you probably kind of keep raising your downside stop.
All right. So let's do the if first. If it were to break through that support level, which we drew, you're probably looking at this sort of the late February, March, April lows. So what is that? 1,800 or so. So that's the first if. You brought up the fact that central banks are hedging their own ineptitude. 100%. I mean, you can look at the statistics. They've clearly been buying gold. It has not manifested itself in the price. The strength of the dollar obviously creates a bit of a headwind. And I think it's that Pavlovian in the response that the gold market is seeing. Higher rates, higher dollar, lower gold. All makes sense to me. I think what the gold market is missing, again, my opinion, is the fact that genie's out of the bottle with a lot of these things. Specifically, we mentioned Japan earlier. Dollar yen's going to approach 150. The Bank of Japan is not going to be able to stop that dollar weakness. And at a certain point, I think that currency crisis historically and I'm using the term by choice, have been very bullish for gold. So I think we're on the precipice of that with Japan. Clearly, nobody's talking about what's going on in China and their currency. I think there's a potential for that there. And at a certain point, if things were to start to go pear-shaped in terms of the things we mentioned earlier, credit cycle, credit, a credit event in the market, I think people are going to find the way in the gold market. It certainly doesn't look like that now. People will say you're being dogmatic. They're right, but I do like gold still.
All right, two more things quickly before we get out of here. And this is kind of a hard turn here. I want to talk about American Express. And this is a stock that has not seen an uptick, Guy, in about a week and a half. Okay. So we've been talking about a consumer that's strapped, and it's probably a lower wage earning consumer. Okay. American Express. This is one where this company has credit risk. It's not Visa or MasterCard where they're just processing for the most part.
Processing transactions. Yep.
Look at what's going on here. And I love American Express. I think it's a great company. I actually got in the mail yesterday for being a 10-year business card. No, they sent me $100 gift card, which I thought was really nice to be used. They bought that company Resi, the reservation system, $100 gift card. And
hold on a second. A what?
$100.
No. But after that,
Resi is a reservation service that you book.
Okay.
So listen,
wait, hold on a second. And I apologize.
If you're doing that, you're doing it wrong. Well,
you know how I book reservations? I actually call up the restaurant and say, hey, how are you? Do you have the table for 2 at 7:30 on Friday? So people actually do this online now.
People actually, Guy, a lot of restaurants in New York City, I don't know what they do out there in Morristown, and I don't mean to be, but they don't even have like lines you can call for the most part. They just want you to. All right. But the upshot of it is they sent me $100 gift card to use at a Resi restaurant, and they sent me pasta and pasta sauce. I don't know. They said, make dinner at home too. Very nice of them. I love the company. I really do. Hasn't seen an uptick in a week and a half. Look at how volatile this stock has been this year.
Yep.
What is this saying possibly about delinquency?
Credit delinquencies, 100%. And by the way, Capital One, if you go back like 8 or 9 months, I start to get confused on time, but Capital One, Discover Financial, they all started to make comments about this months ago. Yeah. So American Express is not impervious to this, but that's exactly what it's saying. Sorry.
Yeah, well, I mean, listen, your point about Capital One is that's meant to be, maybe possibly close to a subprime sort of lend. Look at the volatility. This stock, it looks like an EKG. So American Express is starting to look more like it. So let's keep an eye on these two. Last thing before we get out of here, and you tell me, is this a decent read on, what does Costco have to say after the close? The implied move in the options market. So they report earnings tonight, about 3% in either direction. The chart's a monster. I mean, that's a good, but what causes a breakout and what could cause a pullback towards that uptrend, which happens to be trending very near that 200-day moving average, which is kind of flattening out. But this is, you're going to say it's an expensive stock, and they have that recurring revenue base for the membership.
So the membership, I think they have like a 92 or 93% retention for their membership, which is extraordinary if you think about it. This is an environment where Costco should do extraordinarily well, without question. It's a great company. The problem, of course, is valuation. So nobody's cared about valuation. The question, I guess, is the market going to care about valuation? So if they come in line, if they talk about guidance, that might not be enough. I will say flat out, this stock, it's a great company. Will it continue to be a great stock? I'll say this, and if I'm wrong, I'll come back tomorrow. There's a chance to see a knee-jerk higher, but I'm hard-pressed to believe this thing has enough in the tank at this valuation to continue to extend to the upside. I think there's a likelihood that we see that uptrend line, or effectively the 200-day moving average, which comes in both of them around 510, 511.
Yeah, worth noting, expected EPS growth next year, 8%, revenue growth, 5%, trades 36 times. Okay, so
big
that's
valuation.
Well, that's where that 92% retention rate for those, that recurring revenue stream comes in versus a Walmart, which is expected to have high single digits EPS growth, mid single digits or low-ish, revenue growth, and it trades at 23 times or so next year. So, to me, do I like trading earnings? Yes, sometimes I like defining my risk, using options, that sort of thing. Here's one where I'm more interested to see what the company has to say, what's directional on some of the stuff as it relates to the consumer. And then also, if they do have a beat and raise, which again, you just said there's a chance, how does the stock react? Does it gap up and then get rejected and then find its way back? So to me, all interesting stuff. All right, Guy Adami, we covered a lot of ground today on the market call. We're going to be back. Well, actually, I'm not going to be back tomorrow. You're going to be back tomorrow for the full half an hour with Carter Braxton. Hardboard charting. Yeah, you didn't get the memo. I'm out tomorrow. I got something else.
No, do you think? There were more people watching this live broadcast than showed up at Yankee Stadium yesterday, which is more of an indictment of the Yankees than it is sort of a praise of what we're doing. But I think the numbers don't lie. I mean, it's amazing. There was nobody freaking there. And you know what? I can't blame them. Why would you go? It was shitty out. They suck. It reminded me of late 60s Yankee Stadium when when a lot of people showed up as empty seats. It was eerily reminiscent of what goes on at Shea in a normal year.
Yeah. Guy, you're gonna well, I don't know what you're gonna think of this. Last night we have some friends in town from California. We were gonna take them down to San Gennaro. We were gonna go to one of my faves, Ruby Rosa, which is a great Italian place. It's in Nolita. And
it's in, wait a second. So what?
Nolita, north of Little
like Italy. The Vladimir Nabokov book?
North of Little Italy. And we had to
Nolita. It's not Lolita. Okay.
Nolita.
By the way, not a lot of people are pulling Vladimir Nabokov out of their ass. No, I'm just telling you.
You just did. But it was a really sad affair. I just wanted some Zeppelis. I just wanted some fresh Zeppelis after. And you know what? We get down there and they're breaking down everything in San Gennaro. I missed it by a day. So,
well, it's unfortunate. That's what are you going to do?
All right. Well,
you can still get a great meal down there. I mean, it's not like they closed Little Italy.
Guys, follow us on the YouTube. If you're watching this on YouTube and you're not subscribing, follow us. Leave feedback in there. Our team is reading that feedback. We're trying to gauge a lot of the programming to some of the feedback in there. So we appreciate you being with here. We appreciate FactSet, Guy. We appreciate CME Group, two of our very fine sponsors across the Risk Media platform, and we appreciate you guys being here.
We do. We'll be back. I'll be back tomorrow with Carter Braxton Worth of Worth Charting. Enjoy the rest of your day, people.
All right. Thanks.